Inflation is way worse than we think, and this is compounded by the fact that we have zero control over it. So we avoid even thinking about it too much because what am I going to do? I still have to spend money to, survive. It feels helpless, and it sucks seeing the same money buy less month after month after month. People are delaying retirement. They're even getting rid of their pets.
Hey, Bandit!
So I needed a plan. I'm done being a passive observer of inflation. I need to analyze all the famous methods to not only beat inflation, but profit off this thing. And I'm sharing that plan with you. So let's start by looking at the most classic inflation hedge of them all, gold. Does it really make sense to invest? I've heard so many stories for and against this shiny yellow stuff, I really don't know what to think anymore. So straight away, a look at its price action over the last 4 decades shows that it has performed quite well. Okay, maybe there's something to this. But then I looked at earlier recessions, and it's a mixed bag. During the 1973 recession, gold blew everything out of the water. But look closer and it turns out that was a unique situation. This was right after the US officially came off the gold standard, and gold doesn't work in every recession. It lost significant value in the 1948, 69, and 80 recessions. However, more often than not, it does all right. In 9 out of the last 15 recessions, gold held its value. But here's the thing, we're not always in a recession. From 2001 to 2021, gold only increased in value by 9.48%. Total, far lower than most other asset classes. So it looks to me like gold could make sense if you feel a recession may be coming, but not great once we're already in one because the downturn will already be priced in. A small allocation here might be all right. Conventional wisdom says around 5% of your portfolio could go to gold if you like gold, but this isn't the kind of thing that's going to make you rich. So I'm personally going to leave gold alone for now. But what about bonds? There's actually an amazing strategy here. Bonds are this lower yield asset considered safe and called a boomer investment. And a lot of bonds are doing poorly this year. But when I looked into it, one kind of bond really stood out to me. I-bonds, no affiliation with Apple. Here's what's interesting. The rate of return for I-bonds is tied directly to the CPI, or inflation rate. So looking at the inflation chart, this means these bonds must be having the best year ever, right? Yes. These bonds are currently paying 9.62%. The only real downside is when inflation falls, so does the return. So you can guarantee that 9% return for 6 months, where it will then be updated to reflect new inflation numbers at that time, which means it'll probably decrease just slightly. After that, the return is adjusted twice every year, again according to the CPI figure at that time. Now what about safety? 9% seems too good to be true. Well, good news is, just like all other treasury bonds, I-bonds are fully backed by the US Treasury, the guys who print all the money. So as long as the US government doesn't go full Celsius and default on its loans, you'll get your money back. Speaking of the Treasury, that's where you need to buy I-bonds. You can't just go to any old brokerage. It's not in person either, thankfully. Can you imagine that? You can buy them online via the Treasury Direct website. It takes about 15 minutes to complete the whole process, but there is a catch. You can only buy $10,000 worth per year in these electronic I-bonds, and you must hold a bond for at least a year. However, unlike most other government-backed securities, you don't have to pay any taxes on earned interest until you cash the whole thing out. And even then, you only pay the feds, no state or local taxes. So while I-bonds aren't going to 100x your cash, they are a great way to safely earn ROI on cash that would have just sat in a high-yield savings account. I've been looking into buying a house recently, and this made me wonder whether real estate could be another way I can make money in spite of high inflation. But here's the thing, no matter where you live, home prices just keep going up. The average home has doubled since 2000. So if home prices continue to increase over time, then it shouldn't really matter when I buy, right? No matter how much I pay now, the house will just be worth more in the future. Not exactly. Nothing, not even real estate, goes up forever. Here's a story for you. I bought my first house in 2017 for $365,000. The sellers owned it for 11 years before me, and guess what they bought it for? $360,000. They made $5,000 in 11 years because they bought at the top. Then since I've owned it, it doubled to $750,000. So pullbacks and market corrections are inevitable. And remember that with the Fed raising interest rates and a looming recession, it's becoming harder for many people to purchase a home right now. leading to the market finally showing signs of cooling off. This could lead to some actual deals in the coming months, not just these small condos for $1 million. Who's buying these things? So I'm looking to buy real estate that I would live in for a few years and then eventually rent out. This means finding a diamond in a rough market. Here's 4 things I'm doing. Number 1, I got my pre-approval for a mortgage first so I can make offers like that. Speed is key, especially here where I live in Puerto Rico, where there's a lot of people looking for whatever you call like one step below a mansion. Like mansion light, I don't know, call in if you have a better term for that. Number 2, I've made it part of my daily routine to check new home listings in my area. If I see anything interesting, I inquire immediately on that property. Number 3, sending letters to off-market homes that I like in my area. Sure, maybe they're not for sale, but I know many homeowners will at least entertain an offer. It's kind of like hitting on your crush. Worst case, she's flattered. I guess maybe she could call the cops, but Number 4, embrace the difficulty. My favorite house I'm negotiating on right now was the hardest to deal with. The showing was a hassle, the agent was a hassle, none of it has been easy, but it's by far the nicest house in the price range, and I know there aren't many bidders because the sellers have done a terrible job making it easy to love this property. I see that as an opportunity, not frustration. So I'm going to take my time, keep doing my research, and when the perfect opportunity arises, it's all mine. Now that we've seen some of the traditional ways of fighting off inflation, let's look at the granddaddy of investments, the stock market. You've probably heard that for long-term investing, the S&P 500 is a good way to beat inflation over time. From 2012 to 2020, the S&P 500 returned nearly 13%, while inflation averaged 2.9%. Honestly, that's very hard to beat. So let's take a look at a longer time frame. Let's jump back to 1930. While individual years vary wildly in the returns they produce, only 30 out of the 92 years in this data set had negative growth, just under a third of the time. So we're sure to make huge gains in the long term, right? Well, from 1950 to 2009, the S&P 500 outpaced inflation by 7%. That's good, but not amazing. Considering the US became a superpower in that time, you'd maybe expect it to be a little higher. I mean, don't get me wrong, I like index fund investing. It's the base of my portfolio. I think that should be the majority, but that alone isn't going to make me rich in the short to medium time horizon. So let's look at what the pros do. Well, one in particular, maybe you've heard of him, Warren Buffett. Buffett is famous for his value investing approach. This means investing in productive companies that will continue to be profitable for at least 5 to 10 years from now that are presently undervalued. His advice: don't just look at the stock price. Evaluate whether the company is adding value and will continue to do so in the future. This means doing your homework on the company and the market in which it's operating. Now, here's something really interesting about Buffett. He missed out on many early tech companies because he didn't understand the technology nor the industries. If it's outside of what he calls his circle of competence, he avoids it because it's some degree of speculation if he doesn't fully understand it. Basically, if you don't understand it, you're kind of investing and crossing your fingers. Not a great idea according to Buffett. And I've used his strategies to massive results in the past. Many of my best investments in the last 2 years have been thanks to his strategies. Here are a few of them. But here's the thing. Like real estate, you need to be super diligent to find these kinds of deals. And it typically means investing when there's some kind of bad press or some event happening that makes the stock overreact negatively. Here's a few keys to finding stocks that can actually make money even during high inflation. Look for companies that pay dividends, meaning they're paying some percentage of their earnings to shareholders. I typically look for 2 to 7%. And they have a loyal customer base that's willing to bear some degree of higher prices, meaning the company has a high perceived value. Starbucks is an example of a company with a large market share, and its customers would likely stay if prices increased 15%. The problem is everyone knows Starbucks is a great stock, so it's not often priced at a discount. This is where you need to be patient and always on the lookout. Whenever I'm feeling a little anxious, like I need to place my money somewhere and get invested right now, I remember that Warren Buffett right now is sitting on over $100 billion. If he can be patient, so can I. Now, stocks, they can be a little bit overwhelming, so I've designed a really helpful tool to filter out which stocks are a good buy at any given time. It's essentially a big stock screener with explanations of what to look for in the left-hand column. It'll be free in the description down below. And while you're down there in the description, you'll want to check out our exclusive finance membership site, Finova. There we have live calls with professional investors daily, investment research, and buy alerts like this one where I recently made 34% in just 12 days based on research that we posted right there on Finova. Now, Inflation is a truly destructive force, and the thing I hate most about it is it's largely beyond our control. So let's control what we can, because the brutal truth is inflation is far worse for those who don't invest. This is kind of terrible, but inflation should be looked at as a tax on the poor. Assets eventually increase in price to fair market value. Cash doesn't, meaning the wealthiest people have the easiest time in inflation. It sucks, but it's true. So again, it's our job to control what we can, and that means making wise investments in the face of inflation. There's no other choice.